Hello everyone. Good morning, good afternoon, good evening, depending upon when you are watching this video lecture. In the chapter of budgetary control and preparation of budgets as part of the cost and management accounting syllabus, we discussed about the flexible budget and preparation of functional budgets like production budget, purchase budget, etc. But while solving those questions, some of the problems have been left out intentionally because solving those questions, though they are mentioned and given in budgetary control chapter, solving those questions requires an understanding of the standard costing theory and concept also. That is why then those questions were left out. Today let us discuss those questions in the chapter of budgetary control, which apply some of the aspects and some of the concepts that we have learned in standard costing also. But before going ahead to solve these questions, first and foremost thing is we have to definitely remember, if you call it by heart, yes, you have to do that, because these are ratios to be used for solving the questions related to them. But of course, just by hearting without understanding is not required, but just understanding without memorizing the ratios is useless also. So ultimately both of them will have to be done. Whenever there are formulae, they have to be remembered. That is the top priority. So note down these formulae. I would suggest one of the techniques of remembering things is to write down on the paper rather than just glazing at them. So take down these formulae first on the paper. Those are there in the ICA material as well. And using this formula, we can find out and calculate these ratios. And these ratios will be helpful in the real life also for understanding the performance of the organization as a whole and how the efficiency in general of the organization is in terms of comparison between what was planned and what is actual. So each of these formula has to be remembered perfectly. And also let us understand what do they depict. First formula is efficiency ratio, which is standard hours divided by actual hours. And once again, standard hours don't get deviated. As we know in the standard costing, what is standard hours? That is SH. SH means standard hours required for actual output. And even if you can remember like that only, that is much better. Otherwise, standard hours as a name does not indicate anything. It has to be remembered like standard hours required for actual output divided by actual number of hours which are really taken. So efficiency ratio is that. Just understand this one. If let us say efficiency has to be high, then what is the possibility? The possibility is that the actual hours taken should be low. That means the denominator should be low. When the denominator is low, automatically efficiency will be high. And if the denominator is high, then efficiency will come down. So this ratio indicates how efficiently the work has been undertaken within the organization for a production process, or for that matter even for a service sector also they can use it. But mostly, as we observed also, we consider production as our case to be studied in most of the chapters in this costing paper. So that is efficiency ratio, standard hours required for actual output divided by actual hours. Lower the number of actual hours taken, then better the efficiency it is. Then second ratio is activity ratio. Activity ratio means what percentage of activity has happened when compared with the budgeted hours. So this is where we have to be very clear. Once again, referring to the standard costing knowledge, budgeted hours are different, standard hours are different. Budgeted hours means what? Those are budgeted for a budgeted level of activity. At the beginning of the year, a master budget will be prepared, and that will be prepared estimating that, okay, this could be the level of activity. But real actual level of activity could be completely different from that. So budgeted hours are those which were budgeted for the budgeted level of activity. And then numerator is showing what? That is standard hours required for actual production. Of course, budgeted hours are also standard hours only, but you can understand them like standard hours required for budgeted production. So in other words, we can understand this activity ratio like this: standard hours required for actual production divided by standard hours required for budgeted production. And what is the denominator ultimately indicating is budgeted hours. How many hours were budgeted and how many hours were supposed to be required for actual production. That shows the activity that has been done in the organization. So it's called as activity ratio. Then calendar ratio is one thing, like you had a calendar variance also in fixed overhead variances, if you remember. Similar thing. That is available working days divided by budgeted working days. In other words, how many days are actually worked available divided by budgeted working days, how many days were budgeted in a particular month or year. That gives us calendar ratio. Simply speaking, this shows if there are any unplanned leaves, unplanned holidays. Otherwise, normally both numerator and denominator will be same. In general, if all the days which are planned to be worked are really open, then calendar ratio will be always 100%. But if there are any unplanned sudden holidays, then calendar ratio will be definitely less than 100%. Imagine, for example, some more days are worked also, even on holidays there was work done. Then calendar day ratio could be even more than 100. So depending upon the reality, how many number of working days were available during the month and how many number of working days were budgeted during the month. The ratio between them is called as calendar ratio. You need to remember all these ratios. But while remembering standard hours, be very careful. Actual hours, budgeted hours are they themselves depicting what they are, but standard hours name will not tell us anything. You need to remember like standard hours required for actual output. Other than that, remaining things are self-explanatory. Calendar ratio is available working days divided by budgeted working days. Then fourth ratio is the standard capacity usage ratio. In this denominator is the maximum possible hours in the budgeted period. How many hours are maximum possible hours according to the plan, according to the budget? In that, how many hours are actually budgeted? In other words, how much percentage of capacity is contemplated to be used? Maximum possible hours is different, budgeted hours is different. Not necessarily always the organizations will use 100% of its capacity. If the budgeted capacity is only 70%, that means standard capacity usage ratio will be 70%. So that is shown by calculating the ratio between two items, budgeted hours divided by maximum possible hours in the budgeted period. That gives us standard capacity usage ratio. Then what is the actual capacity usage ratio? Denominator is same, which is maximum possible working hours in a period. Numerator changes. Numerator is actual hours worked. So standard capacity usage ratio will have a numerator of budgeted hours. Actual capacity usage ratio will have a numerator of actual hours worked. But both will have the same denominator of maximum possible hours in the period, which is the budgeted period. So that is the capacity usage ratios, we can call them. Then actual usage of budgeted capacity ratio, and another thing. Out of the budgeted hours, actually how many hours are worked? So that's what is actual usage of budgeted capacity ratio. Name itself indicates. So actual hours worked divided by budgeted hours. Into 100 is there in all cases because these are all expressed as percentages. These are the 6 ratios. We can call them as budget ratios, performance ratios also we can call them, which depict the performance of the organization for a period. So write them down, and if you require, write them down 2-3 times also, but remember them well, and remember the terms and what are they representing very well, which ideally we already know all these items in standard costing also. Of course, all the data will be given in the question. We all just need to substitute that data into the formulae which are here and then get the answer. That is how such questions can be solved, and very much possible. A lot of times students just ignore this. These are some ratios only there, nothing much exciting here. But believe me, 5 marks questions are quite possible anytime. And so easy to get those 5 marks. Only with our negligence we can lose those 5 marks. So as usual, don't be negligent. Don't be just casual while approaching these ratios. It's only just formula and substitution, nothing big deal. But nothing big deal does not mean we will remember the formula automatically. We have to do effort to remember the formula. That is why write them down on the paper. Once you know the formula, once you have done that, let us solve the question related to applying that series of formulae. Those are given in question number 5. Following data is available for DKG and company. Standard working hours are like this: 8 hours per day of 5 days per week. So in a week there will be 5 days. Each day will have 8 hours. That is the normal working hours. Maximum capacity is 50 employees. Actual working is only 40 employees. And actual hours expected to be worked per a 4-week period. Expected to be worked were 6,400 hours. We can also call them as budgeted hours. That's what was expected. And standard hours expected to be earned or worked for 4 weeks. That is 8,000 hours. But can we take that as standard hours? No. Be very careful. Standard hours means standard hours required for actual output, not standard hours required for budgeted output. So actual hours expected to be worked for a 4-week period are 6,400 hours. That can be taken as budgeted hours. But standard hours expected to be earned for 4-week period 8,000 cannot be taken as SH. Be very clear. That is a misleading, unnecessary information. But we can say that can be the maximum number of hours. Totally. If at all the employees are working, like 50 employees are working, then yes, then that 8,000 is possible. But that is not standard hours required for actual output at all. That we have to calculate. It is not given in the question. Or maybe it is given in the question also in the next one. Yeah, actual hours worked in the 4-week period is 6,000. Standard hours earned in the 4-week period is 7,000. That is also given. Standard hours earned is also given. Say actual output is not given. That is why we cannot find out standard hours separately. If it is required, we would have found out. Because it is given already standard hours earned in the 4-week period. That is SH. That is really worked, right? Then only they are earned. So standard hours required for actual output is 7,000 hours. Actual hours worked is 6,000 hours. Budgeted hours are 6,400 hours. And total capacity for the week is, for the 4 weeks is 8,000 hours. These are the various number of hours which are given. And the related period is that of 4 weeks. In this period, there was only one special holiday due to a national event. So suddenly what was planned was a different number of days, and what happened is different number of days because there was a special holiday on something happened, whatever it is, we don't care. So that is one more point to be noted for calculating particularly calendar ratio. And all that we are required to do here is substitute in the formula and get the answer. Let us solve them one by one. First formula, first ratio is efficiency ratio. What is efficiency ratio formula? First that we should remember. That is SH divided by AH. Means standard hours required for actual output divided by actual hours worked. What is the standard hours required for actual output? That is given already. That is 7,000 hours divided by actual hours worked is also given. That is 6,000 hours. So 7,000 by 6,000, of course, multiplying with 100 will give us first ratio, that is efficiency ratio. Do that calculation. Simply 7 by 6 into 100. That comes to around 116.5 0.67%. That is the first answer for efficiency ratio. So this is done. Then the second one, activity ratio. Formula for activity ratios is standard hours required for actual production divided by budgeted hours. So once again, 7,000 is the standard hours required for actual output given in the question, divided by budgeted hours are 6,400 hours into 100. Do that calculation. 70 divided by 64 into 100. 109.375%. So that is what we can call as activity ratio. Then the third one, that is calendar ratio. What is calendar ratio? Number of working days actually worked divided by budgeted working days. So normally how many hours are supposed to be, how many days are supposed to be worked according to the question? It was 5 days per week, like that 4 weeks, means 20 days are supposed to be worked. So in calendar ratio, 20 days are supposed to be worked, but how many days are actually worked? Naturally, because there is one holiday, 19 days are only worked, which means calendar ratio will be 19 divided by 20 into 100. That is 95%. That is the answer for third question. All direct substitution and answers, that's all. Then standard capacity usage ratio. That is basically the budgeted hours divided by maximum number of hours that are available for the period. Budgeted hours are given in the question, that is 6,400 hours divided by maximum number of hours that are available for the 4-week period is 8,000 hours. Those are possible to be worked if all the 50 employees were working. You can calculate that also actually separately. Let us say 50 employees are working, full capacity we are talking, maximum capacity, and how many days a week? 5 days a week, like that. How many weeks in the month? 4 weeks. And each day how many hours? 8 hours. Do this calculation. 50 into 5 into 4 into 8. That is 8,000. That is the same thing. Maximum available hours. And budgeted hours are given already. That is 6,400 hours. That is the actual hours expected to be worked for the 4-week period. And how that can be also calculated actually. Because instead of 50, if you take 40, say 40 here, because that is the number of people who are actually working, that is 40, and multiply. Budgeted was 5 days a week, budgeted was 4 weeks a month, budgeted was 8 hours a day. So 40 into 5 into 4 into 8, that is 6,400 hours. That is budgeted hours. So both can be calculated like that. But the point is, we don't need to do that also. Why? Because already they are given in the question. Why should we do? So 6,400 by 8,000 naturally will be 80%. That is the answer for the fourth question, which is standard capacity usage ratio. Then the fifth question is actual capacity usage ratio. Actual capacity usage ratio will be actual hours divided by denominator is common, that is 8,000. Numerator will change. What is numerator? Actual hours worked. That is fact. That is not budgeted something. That is the real number of hours which are worked. So that is 6,000 hours. So 6,000 by 8,000 into 100. So that would be equal to 75%. That is the answer for fifth question, 75%. Then the last person, actual usage of budgeted capacity. Actual usage of budgeted capacity. Actual hours worked is 6,000. Budgeted capacity was 6,400 into 100. So 6,000 divided by 6,400 into 100. That comes to 93.75%. That's all. These are the various ratios which were asked in this question. So answers are finally these: 116.67%, 109.375%, 95%, 80%, 75%, and 93.75%. That is the answer for question number 5. And all the ratios have formulae, and the data related to the number of hours is already given in the question also. That's it. That is how you calculate ratios. Very, very important. Particularly for first compulsory question, 5 marks question, these type of questions can be very well expected. Easy 5 marks will be in pocket, provided if you are thorough with the formulae, then only. Otherwise, you will be looking at the question, then you will be cursing yourselves, or I should have remembered those formulae. But they will not come just like that in the memory in the exam hall. That will be the situation I am telling you with experience. Don't fall in that wrong thing. And right thing is to simply remember the ratios and just use them if a question comes from that. That's all. That is question number 5. Then question number 8 also had something related to variances, which we did not do. So let us look at that now. Question number 8. TQM Limited has furnished the following information for the month ending 30th June, whatever it is. Master budget is given, actual is given, and variances are given. Master budget was this: they thought of producing 80,000 units, but they produced only 72,000 units. That is number of units, by the way. So no variance and all. That is number of units of budgeted number of units, actual number of units produced and sold. Sales also naturally are there, which is 3,20,000 rupees. Actual is 2,80,000 only. Let us see if there is any sales price variance also, because 3,20,000 divided by 80,000 means they have budgeted a price of 4 rupees. 2,80,000 divided by 72,000 means they were able to sell at 3.88 only. So they could not sell at 4 rupees. So there is a change. But anyway, there is a total sales variance as given here of 40,000 rupees adverse. Then the other types of information related to costs is given, all the costs. Material, wages, variable overhead, fixed overhead, all the cost details are given. Master budget is given, actuals are given, and then variances are also given. But once again, this is not what is real or correct variance. That we should know. Why? Because master budget is prepared for all these costs for the budgeted level of activity. That cannot be compared with the costs related to actual activity that has been really performed. So if you compare these two, the variances will be like definitely misleading. And I would like to remind you the example I told earlier. If you have two friends who planned to go to a movie with a total budget of 1,000, and actually one more friend added, and finally 3 friends went to a movie and a budget of, say, actual expenditure of 1,300 only happened. If you look at these two, it looks like there was a adverse variance of 300. But reality is that there is no adverse variance of 300. Rather, there is a favorable variance of 200, because for 2 people, if the budget was 1,000, for 3 people, it should have been 1,500. So you should have spent 1,500, but you ended up spending 1,300, means you saved 200. But if you just look at the numbers without looking at the level of activity, it is misleading. It shows as if like there was an adverse variance of 300, which is wrong. How wrong that is? This also is the same wrong. These variances which are shown here are not showing the real correct picture. Comparison between master budget and actual is not correct. That is okay for only fixed overheads, not for anything else. Because for fixed overheads, 40,000 is budgeted. That itself is standard also. There is no difference there. So comparison of master budget versus actual is only okay for this. 800 favorable, that is okay. Only for that. For all others, it is not correct, because when the level of activity changes, automatically direct material, direct wages, variable overheads will also change. Accordingly, we have to rewrite this budget for the actual level of activity, and then we can compare with the actual cost. This actual cost is reality. This is all budget. So the budgeted level of activity and costs attached to that cannot be compared with the actual costs which are related to the actual level of activity. Those are not comparable by themselves. That is why we need to definitely rewrite this budget. That is what we call flexible budget. But let us look at the standard costs of the products like this. So direct material takes 1 kg at the rate of 1 rupee. So 1 rupee per unit, that means. Direct wages is 1 hour at the rate of 1.5, that means 1.5 rupees per unit. Variable overhead is also 1 hour at the rate of 0.5, that is 0.5 rupees per unit. So that can be even observed in the master budget also. Let us say 80,000 units are produced and sold. Material cost is 1 rupee, means that is 80,000. Same way, 80,000 units are produced and sold, budgeted, and 1.5 direct wages means budgeted wages cost will be 80,000 into 1.5, 1,20,000. Same way, 0.5 into 80,000, 40,000. So that is standard costs per unit which are given. Actual results for the month showed that really how many kgs of material are used? 78,400 kgs of material were used, and 70,400 labor hours were used. That is the reality. Those are actual results, once again, given in the question. Now, what we are supposed to do in this question? Variances are given, which we don't care. Actually, those are not actually useful also much. But what we are supposed to do in this question is, we are supposed to prepare a, first of all, flexible budget for the month and compare with the actual results. So we have to first prepare flexible budget, then compare with actual results. And see this question. This is a mix of both budgetary control and standard costing. That is how questions can be framed. And this was a past exam question also, by the way. We have to calculate all the variances. What are all variances it was asking? Material variance, labor, sales price variance, variable overhead and fixed overhead, expenditure variance, sales volume variance, that means profit variance also is asking. So different types of variances are asked here. That is the second question. But before that, we have to prepare a flexible budget. How well framed question it is for a 10 marks question, perfect question for 10 marks. For two reasons. One, it perfectly gives the idea of distinction between standard costing and budgetary control. And second thing is, it is using both the topics of standard costing with the flexible budget concept. At the same time, it is also using the standard costing variances concepts. So budgetary control and standard costing both are put together, required to be applied for solving this particular question. Let us do this question number 8. First question was prepare flexible budget. Okay, let us prepare a flexible budget. Flexible budget means what? Whatever was given was master budget, and we need to prepare a flexible budget. Then we have to compare with actual. Then of course there can be variance, because that was also asked. Compare with actual results, he said. So first of all, this is master budget, what is given in the question. Master budget is at what level of activity? That first of all we have to see. At what level of activity master budget is? 80,000 units level of activity. But flexible budget we have to prepare, this is also budget by the way, not actual. Budget we have to prepare for 72,000 level of activity, which is the actual level of activity. Then actuals are realities, actual costs are given already. Then variances can be formed at a broader level. Yes, definitely the variances can be formed. Let us take the numbers one by one from the question itself, what was given in the question. In the master budget, first let us take them. Once we have them, then flexible budget, we have to find out changing the percentage of utilization, or you can say the number of units which are there. So number of units for master budget is 80,000. Number of units for flexible budget is also 72,000. Actuals is also 72,000. By the way, variances are just for rupees. So this is all in rupees. We are going to mention one by one. So let us take the items as given in the question only one by one. Let us take sales. Sales 80,000 units at the rate of 4 rupees. That was supposed to be 3,20,000 rupees. But flexible budget should be for 72,000 units only. So 72,000 into 4 will be how much? Only 2,88,000 rupees. Because budgeted selling price was 4 rupees per unit. That is clear from here. 3,20,000 divided by 80,000. Budgeted sales were 80,000. That was the plan, but did not happen, right? Actual sales are only for 72,000. So ideally, the 72,000 units should have been sold for how much? They should have been sold for 2,88,000 rupees. But how much they have been actually sold for? Only 2,80,000 rupees. Which means good or bad? Bad, because sales are actually lower than the flexible budget. So how much bad they are? What is the variance here? That is 8,000 adverse. That is sales. You can do separately one by one. So 8,000 adverse is sales variance. Then let us take another one, direct material variances. All same logic. 80,000 units, 80,000 rupees means 1 rupee per unit. That was there already in the master budget, nothing special. But 1 rupee per unit, how much it should have costed as per flexible budget for the actual level of activity? 72,000 into 2, 1 rupee. That means 72,000 rupees only it should have costed, because original price budgeted was 1 rupee per unit. 72,000 units is the actual capacity which is used, actual production we can say, and sales. So 72,000 into 1, 72,000 rupees should have been the materials cost. But how much was actual? 73,600 is the actual material cost given in the question. But how much is the variance here? 1,600 rupees. Once again, actual is cost wise more than the flexible budget. So 1,600 adverse is the direct material variance. Comparison of master budget with actuals is what was done in the question, which is wrong. What we have to compare is this. So we are getting the correct variances comparing between flexible budget and actuals. Quickly, same way with direct wages also. All variable costs, variable things will have the same type of logic. So quickly let us go through the other things also. Direct wages, how much they will be? Master budget given 1,20,000. Per unit it was supposed to be 1.5. How many units are actually produced? 72,000 units. Means how much it was supposed to be as per flexible budget? 1,08,000 rupees. But how much was actually spent? 1,04,800. 1,04,800 only was spent. When it was less amount spent, 1,04,800, there is a favorable variance of 3,200 when it comes to direct wages. Same way, for variable overheads, same logic can be applied for variable overheads, no problem. How much was budgeted? Master budget 40,000. How? Because 80,000 units at the rate of 0.5. But flexible budget will be how much? 72,000 at the rate of 0.5. That will be naturally 36,000. That is flexible budget. But how much was actual expenditure? Sorry, looking at fixed. So this is 37,600 is the actual expenditure for variable overheads first. Again 1,600 adverse is there for variable overheads budget. Coming to fixed overheads. Fixed overheads is the only place where flexible and master will be one and the same. How much was original? 40,000. How much was flexible also? 40,000. Fixed overheads are supposed to be fixed. They will not change according to the level of activity. So that is master budget also, flexible budget also. In flexible budget, they will not change. Any level of activity, they are supposed to be 40,000. That was budgeted. That's it. But how much is actual? 39,200 is actual. That means there is 800 rupees favorable fixed overhead variance. That is the different types of variances here. Now we can even calculate the total of all the costs. Total cost, we can take. How much is the total of all these costs according to the master budget? 80 plus 120, 2 lakhs, plus 40 plus 40, 2 lakhs, 80,000. How much is the total cost according to the flexible budget? 72,000, 1 lakh 8,000, 36,000, 40,000. 2 lakhs 56,000. Right? Then how much is the actual cost really incurred? 73,600, 1 lakh 4,800, 37,600, 39,200, 255, 200. So as far as cost is concerned, there is a lesser cost that is incurred, 256,000, 255, 200. That means there is a favorable variance of 800 rupees in terms of total cost. Same thing can be even calculated for profit also. How much is the profit now? Sales we have 3,20,000, cost was 280. That means budgeted originally according to the master budget, profit was budgeted at 40,000 rupees. But not possible. The actual activity was less than budgeted. According to the flexible budget, how much should have been the cost and profit? 2,88,000 sales, cost was 256,000, means profit was supposed to be 32,000. But how much it became? Sales were lesser, but cost also there was a little bit favorable variance. But end of the day, 280 minus 255, 200. 280,000 minus 255, 200. 24,800 rupees is the actual real profit that they have made. 32,000 they were supposed to make, but they made only 24,800, which means there is an adverse variance of 7,200 rupees in profit itself. How this came, you can easily identify. There was an adverse variance of 8,000 in sales, favorable variance of 800 in cost. So in profit there was adverse variance of 7,200. That is the overall variances as compared between master budget, flexible budget and actuals. Master budget actuals were already given in the question. We don't need to do that. What we have done here is comparison of flexible budget, which is nothing but cost budgeted for actual output. Standard cost for actual production, you can call it. That's what is flexible budget we are talking about. Comparing it with actual will give us the total of each of these variances. That is sales variance, material variance, wages, or variable overheads, fixed overheads, everything. Profit variance also is there. But the question is not over. Question is extended to even some more detailed variances which were asked here. For example, what was asked is material variance, labor variance is asked. See, material variance we don't have to calculate once again. What is material variance? Standard cost of materials required for actual production minus actual material cost that is incurred. We already calculated. So direct material variance is 1,600 adverse. That is already known. But if we want to calculate the details of the material variance, that can be done. Because if we said variances, definitely that all we have to do. But when we are in doubt, it is better to calculate all variances possible and show it in the answer sheet rather than assuming he asked material variance, I already calculated, so I am okay, my job is done. That will not be correct. So let us take material variances into detail. We know that total material variance is definitely 1,600 rupees. But how is that? Anyway, there are no other materials here. So let us take SQSP, AQSP, AQAP. Right? So how much was the standard quantity of materials required for actual output? That we already know. 72,000 units. Right? Kgs also. Because 1 unit requires 1 kg. Standard price was how much? That was 1 rupee per kg. Then the question said actual quantity of materials used were 78,400 kgs. This information, when it is there, 78,400, we can calculate the other material variances also. And the standard price, we know that is 1 rupee. AQAP is directly given. What is AQAP? Nothing but the actual material cost. That is 73,600 direct. That is given here in the question itself, 73,600 rupees. Because anyway it is 1, we have all the information required to calculate material variances. So what is 1 minus 2? Material usage variance. And what is 2 minus 3? Material price variance. So how much is usage variance now? 72,000 minus 78,400. That comes to 6,400 adverse, isn't it? Then material price variance is 78,400 minus 73,600, 4,800 favorable. Naturally, the total material cost variance will be 1,600 adverse, which we already know. 1,600 adverse material variance we already know, but the point is we are showing the variances in a detailed manner. What we already know was there. 1,600 adverse was the direct material variances anyway. Like that, material variances can be found out in detail. Same way, as asked for labor variances also, we can do that. Labor variances, we can say SR, SH, SR, AH, and AR, AH. That is labor variances. No RSH, because anyway there is only one type of labor, nothing like that is there. So what is standard rate per hour? 1.5 rupees, be careful. That is standard rate per hour. That is SR. Standard number of hours, how many? 1 hour for each unit. Standard hours required for actual output will be how much? Same, for 72,000 units of actual production, how many standard hours will be required? 72,000 hours, because each unit requires 1 hour in standard. Actual hours are given in the question. How much? 70,400 hours actually worked. 70,400 hours. ARAH is nothing but actual labor incurred, direct wages cost paid, 104,800. That is also given in the question. 1,04,000. Let us do it like this. Anyway, 1,04,800. Others are to be calculated. So 72,000 into 1.5, that is 1,08,000. 1.5 into 70,400, 1,05,600. Now that's all we have: labor efficiency variance, labor rate variance, and labor cost variance. Efficiency variance, how much? Labor efficiency variance, 1,08,000 minus 1,05,600, that is 2,400 favorable. That is labor efficiency variance. Labor rate variance. Rate variance will be how much? 1,05,600 minus 1,04,800. That is also 800 favorable. Naturally, the total of these two will be the labor cost variance. That also we already calculated. How much was that? 3,200 favorable. That's all. That is about labor variances. Then also as asked, variable overhead variances and fixed overhead expenditure variances is particularly asking. Okay, let us find out variable overhead variance and then also fixed overheads expenditure variance. Variable overhead variances can be found out using the similar formula: SRSH, SRAH, ARAH. From the question, what was the standard rate of variable overheads? It was 0.5 per hour. And standard hours required for actual output, we already know. That is 72,000 hours. Then 0.5 is standard rate anyway. Actual hours are given in the question as 70,400 hours. Same 70,400 hours we can write here. Actually it's not required also. Straight away we know the actual variable overheads incurred, right? So ARH is already given in the question. So no need to multiply and all. Variable overheads incurred are 37,600. We know this already. Other things we have to find out. So 70,400 into 0.5 means 35,200, and 72,000 into 0.5 will be 36,000. So once again, variable overhead efficiency variance is 800 favorable. Variable overhead efficiency variance, let us call it. And variable overhead expenditure variance or budget variance. Expenditure variance or budget variance is also 35,200 minus 37,600. That comes to 2,400 adverse. 2,400 adverse, that is because actual overheads is more than the budgeted overheads for actual hours. So variable overhead expenditure variance is 2,400 adverse. So naturally the total variable overhead variance will be how much? 1,600 adverse. Same as we already calculated, same 1,600 adverse is the total variable overhead variance. We are just finding out the details of them. So efficiency variance is 800 favorable, expenditure variance is 2,400 adverse, and variable overhead total variance is 1,600 adverse. That's all. And when it comes to the fixed overhead variances, he has asked for fixed overhead expenditure variance only, particularly speaking. We don't need all the other variances. What is the fixed overhead expenditure variance? Also can be called as budget variance. Is nothing but the budgeted fixed overheads minus actual fixed overheads. That is already known to us. That itself is 800 favorable. How much was budgeted fixed overhead? That was 40,000 rupees, and actual fixed overhead was 39,200 rupees. So naturally the fixed overheads expenditure variance or budget variance will be 800 favorable. That is another question within this. Then also he asked profit variance. Profit variance at a broader level on the basis of sales volume. He is asking how much is the sales volume that was budgeted and how much is the sales volume that is actual. What is the difference between that? And on that basis, how much would have been or should have been the profit originally? That is a standard profit. So if you take the standard rate of profit and multiply that with the difference between actual production or actual sales and budgeted sales, we can get sales volume but profit variance, not on the sales point of view, from a profit point of view. This can be directly done. Say for example, how much is the number of units which are supposed to be sold? 80,000. But how many number of units are actually sold? That is 72,000 only. So 72,000 are actually sold, 80,000 were supposed to be sold. We have to understand, in case of sales variances and sales profit or margin variances, reverse it will be. It will not be budget minus actual, it will be actual minus budget. So that negative becomes adverse, positive becomes favorable. Otherwise positive becomes, if you do it normally, same like others, budget minus actual. And if positive comes, that means actual is lesser than budget, which is bad. So positive becomes adverse in that case. Rather than doing that, let us do it just a reverse way. 72,000 number of units are sold, but 80,000 were budgeted. But how much was the profit that was originally contemplated? What was the total cost here that we have variable cost wise? 1 plus 1.5 plus 0.5, that is 3 rupees. Fixed overheads 40,000 divided by 80,000, 0.5. So total cost that was contemplated per unit was 3.5 rupees. Sales price that was contemplated was 4 rupees. Means for each unit we were supposed to get a profit of 0.5 rupees. So for 8,000 units, how much profit was lost? It is an adverse thing. That is 4,000 rupees. That's what is sales volume profit variance. Because of volume only this happened. We are not talking about the total profit variance. Total profit variance already we know. How much was the total profit variance? That is known to us. That was 7,200 adverse. No, that has happened because of two items naturally. One may be due to the sales price, the other may be due to the sales volume. Because of volume only, what happened? Because of volume only, how much variance has happened is 4,000 adverse. Now that the topic is there, let us also calculate, because it is not asked, but still let us calculate how much would have been the sales, we would say price variance related to profit. I mean in the profit, how much change would have happened due to the change in price, only because of price. When the total profit variance is 7,200 and profit variance due to volume is say 4,000 adverse, the remaining will be around 3,200 adverse. And why this would have happened is because of change in the sales price. How much was the price that was supposed to be sold for? That was 4 rupees. But how much was the price that was actually sold? That you can find out. Taking 2,80,000 divided by 72,000. That means 3.88 only. Minus the cost here, original cost should have been 3.5. So 0.388 multiplied with the difference between budgeted units and actual units approximately. So around, let us say this 8,000 units multiplied with approximately 0.4, that is 0.388. And why that happened? Because of difference between original price and actual price. And that difference has caused the profit variance also of 3,200 rupees adverse. Put together, the total profit variance was 7,200 rupees adverse. So that can also be just calculated as a balancing figure, or otherwise we can just check that why that happened. 4,000 rupees of this 7,200 happened because of volume, and 3,200 rupees happened because of change in the selling price. That's it. So that is about the different types of variances which are asked in the question number 8. Now let us also go through another question also which was not done earlier. That is question number 10. Okay, now it's all okay. So question number 10. Concord Limited manufactures two products using two types of materials and one grade of labor. Shown below is an extract from the company's working papers for the next month's budget as given. Budgeted sales is given in units and budgeted material consumption per unit in kgs is given. There are two types of materials which are supposed to be used by two products A and B. They are manufacturing two products. You have to be very clear. A and B are finished goods. X and Y are inputs. That has to be very clear first of all. And these 5, 4, 3, 6 are given in kgs. The 2,400, 3,600 are in units. So identifying the data correctly is very important. Standard labor hours allowed per unit of product, number of hours that is. So product A takes 3 hours, B takes 5 hours per unit. Then also the costs of material X and Y are given 4 rupees and 6 rupees per kg, and the laborers are paid at the rate of 25 rupees per hour. Overtime premium of 50% is also payable if a worker works for more than 40 hours in a week. And there are 180 direct workers. This is data given about the organization Concord Limited. The target productivity ratio or efficiency ratio for the productive hours worked by the direct workers in actually manufacturing the products is 80%. So efficiency ratio here, what he is talking about, is 80%. So once again, what is the efficiency ratio? The first ratio we talked about, that is standard hours divided by actual hours. That is targeted productivity ratio or efficiency ratio. But in addition to that, there is a non-productive downtime of 20% also of the productive hours worked. Downtime is of 20% of the productive hours worked. So both are given as a percentage related to the productive hours. Non-productive hours are 20% of the productive hours which are worked. And there are 4 5-day weeks in the budgeted period. That means total number of days will be 20 days. That is clear. And it is anticipated that sales and production will occur evenly throughout the whole period. And it is also anticipated that stock at the beginning of the period is given for both A and B materials, A and B also, material X and Y also. See, material X should not be units, it is kgs. Change that. Y also kgs, 1000 kgs, 500 kgs. Closing stocks are given not directly but indirectly. A and B 4 days sales, 5 days sales. X and Y 6 days consumption and 10 days consumption and 6 days consumption. What is required here is, first you have to prepare a material purchase budget and wages budget for the direct workers, showing the quantities and values for the next month. See, material purchase budget is quite common and which is related to production basically. For calculating and preparing material purchase budget, we need to first find out how much should be the production. Without that, it is not possible. First sales budget, then production, then purchase. You know the sequence. Sales is given already. Budgeted sales is 2,400 and 3,600 units. So sales first of all is there already. That is 2,400 and 3,600 units. We are talking finished goods here. As usual, we have to add the closing stock and deduct opening stock of finished goods in order to get what? Production. So closing stock, how much he has given? He has not given in numbers. What he said is, for product A, 4 days sales he says. 2,400 is how many days sales? Number of days here is 20. So 2,400 if it is 20 days sales, how much will be for 4 days sales? So that means 480. Same way, if 3,600 is for 20 days sales, how much will be for 4 days sales? Oh, sorry, material B is not 4 days sales. It is 5 days sales. So 900 naturally will be the closing stock for material B. He has given a number of days of sales. 4 days sales, 5 days sales. Number of days in the entire budget period, entire period is given, that is 20. So if 2,400 is for 20 days, how much for 4 days? If 3,600 is for 20 days, how much for 5 days? That is closing stock. Opening stock is already given, copy paste. 400 units, 200 units. So do the calculation. Plus 480 minus 400 means plus 80. So basically 2480 is the number of units of A that is required to be produced. For B, plus 900 minus 200 means plus 700, which means 4,300 number of units of B is supposed to be produced. But for that much production, how much of material X and material Y will be required? That is an important point. So for each of them, we require material X and material Y. How much X, how much Y would be required? For manufacturing 1 unit of product A, how many units of material X would be required? How many kgs of material X will be required? 5 kgs of material X will be required. So 2480 into 5. 2480 into 5. How much will be that? 12,400 kgs of material X, and for same product A, 4 kgs of material Y would be required. So 2480 into 4, 9920 kgs of material Y would be required. Same way for product B, 3 and 6 for X and Y. So that's it, multiply. So 4,300 into 3, 12,900 kgs, and 4,300 into 6, 25,800 kgs. But on a whole, how much of X and Y are required? That we have to find out separately. How much of X would be required totally? How much of Y would be required? X is the total of these two. How much? 12,400 plus 12,900. 25,300 kgs of X would be required. Y, 25,800 plus 9920. 35,720 kgs of kgs. This is all Y would be required. So that is the material consumption budget, we can call it. Requirement or consumption of materials X and Y in kgs is this much. But there are closing stocks, once again opening stocks, because we want purchase budget. So purchase is nothing but consumption plus closing stock minus opening stock, once again same. So closing stock of raw material X is how much? 10 days consumption, he says. So 25,300 is for 20 days. 10 days means half of that. That is 12,650. For material Y, he says 6 days consumption. So 35,720, that is for 20 days consumption, into 6 days how much? 10,716 kgs. Opening stock is already given 1,500 kgs. These are all. So these are once known, we can find out how much of the quantity to be purchased of material X and Y. Do the math. 25,300 plus 12,650 minus 1,000, that comes to 36,950 kgs of material X would be required, and same way material Y, 35,720 plus 10,716 minus 500, so 45,936 kgs of material Y would be required. That is purchases in quantity. Prices are already given. How much was price? 4 rupees and 6 rupees per kg. 4 rupees and 6 rupees per kg for X and Y. So naturally, material purchase budget in rupees will be how much? 2,75,616 for material Y. 36,950 into 4, that will be 1,47,800 for material X. That is the first question, material purchase budget. It will not come directly. We have to go one by one, step by step. First we need to find out production from the sales. Then from production we need to find out consumption or requirement. From consumption we have to get purchases in quantity. Once we have purchase in quantity, multiplying with the price, we get material purchase budget in rupees. All of that steps have to be followed. Then also what was asked is wages budget. The wages budget definitely has to be prepared carefully with the other data that is given, which is related to the productivity or efficiency ratio as well. Now, the number of units which are supposed to be produced of the output A and B, as we know already, is 2480, and we are doing separately here. 2480 for A and 4,300 for B. Right? So once you have this much production, how many number of hours would be required standard number of hours, how much will be required? It was given in the question. 3 hours and 5 hours. 3 and 5. So 2480 into 3. 2480 into 3. That will be 7440. That we can call it standard hours required for actual output. 7440 hours. And 4300 into 5. 4300 into 5. That can be called also the standard hours required for actual output for unit B or the output B. That comes to 21,500 hours. But what is given earlier already was in this problem, efficiency ratio is 80%. What is efficiency ratio? Standard hours divided by actual hours. That is how much? 80% he says. Then naturally actual hours will be how much? Standard hours divided by 80%, that means 0.8. So do the calculation once again. How much will be the actual hours to be worked according to that efficiency ratio? So 21,500 we have anyway, divided by 0.8 means for B the actual hours required would be 26,875 hours. For A it would be 7440 divided by 0.8, 9,300 hours. That is the actual number of hours which are required for production. But these are only productive hours. In addition to that, it is given that in addition, there is a non-productive downtime budgeted at the rate of 20% of the productive hours worked. Actual hours worked are this much, which are 9,300 and 26,875. Actual hours worked they are, but actual hours paid will be more. Why? Because there is idle time also, which is non-productive. How much is that? Given as 20% of the productive hours worked, really worked are this. On that 20%. So 9,300 into 20% means 1860. Then 26,000, both are same now. Yeah, 20%. So 26,875 into 20% means 5375. This is overtime, you can call it, or idle time actually, sorry, not overtime, idle time. Idle time which is to be paid. Actual hours worked is different, actual hours paid is different. But now how many hours are supposed to be paid now? Supposed to be paid are 9,300 plus 1860. That comes to 11,160 hours for product A, and same way for product B, 26,875 plus 5375, 32,250 hours for product B. Totally, how many hours are supposed to be paid by the organization? Is 43,410 hours. Those are to be paid. Once again, understand the difference between standard hours required for actual output. Actual output is this much. Standard hours are given. So standard hours required for actual output is this much. Actual hours can be found out by knowing the efficiency ratio. That is why without knowing efficiency ratio, we cannot do this problem. Now that we know what is efficiency ratio, we can do this problem. We are doing it, that is why. So the actual hours will be how much then? 9,300, 26,875. AH, that is. Actual hours worked. But paid will be more than that. Why? Because there is a 20% unproductive hours also which are to be added to the productive hours, which are also supposed to be paid. So the total hours supposed to be paid are 43,410 hours. But the story is not over. What he also mentioned, labor are normally paid at 25 rupees per hour. Overtime premium is 50% also if a worker works for more than 40 hours in a week. And how many workers are there? 180 workers are there. And what are we talking about? What is the time period here? Time period here is given, yeah, 4 weeks, right? Yeah, 4 5-day weeks are there. So for each week a worker is supposed to work for only 40 hours. So how many workers are there like that? 180 workers. So 180 workers each week, they are supposed to work only 40 hours. Like that, how many weeks? 4 weeks are there. So how much are supposed to be the real number of hours, normal hours? 180 into 40 into 4. That comes to 28,800 hours are only normal hours. But actually hours are supposed to be paid are 43,410. Which means overtime hours are how many? Overtime hours. Difference between them. Anything in excess of this, they have to pay overtime. So 43,410 minus 28,800. 14,610 hours are overtime hours. That's it. From that we can find out how much is the wages cost. Easily for normal hours, normal rate 28,800 into normal rate was how much? 25 rupees per hour. Okay. Plus, be careful, 14,610 into, don't take 50% only. 50% is overtime premium, means over and above the normal rate. If 25 rupees is the normal rate, including overtime premium, it will be naturally 37.5. 25 plus 50%. So what is the total labor budget? Labor cost 28,800 into 25, 14,610 into 37.5. So the total wages supposed to be paid adding both will be 12,67,875. That's what is asked also. How much will be the wages budget here? 12,67,875. How much will be the materials purchase budget here? If at all we take the total of those two, material purchase budget total in rupees 147,800 plus 275,616. 4 lakhs rupees wise, 4 lakhs 23,416 rupees. So this is one thing. This is the labor budget. That's the question asking us material purchase budget and wages budget, showing the quantities and values. That's what we have done. That's it. That is about some of the questions related to budgets, but using some concepts of standard costing also. And now moving on to another small area of the difference between absorption costing and marginal costing. See, practically speaking, marginal costing as a method, there is no such thing. Marginal costing principles are useful. CVP analysis is useful for decision making purposes. So in reality, nobody uses or actually is allowed also to use marginal costing for accounting purposes as well. Normally when we say costing, that is absorption costing only, which we know. Nothing new, cost sheet type. Just reverse the cost sheet, it is absorption costing. How to calculate profit in absorption costing? Nothing new here. Sales we have to start with. From that we have to deduct the production costs. Production costs include what? Direct material cost, direct labor cost, variable manufacturing overhead, fixed manufacturing overhead also. This is the point to be noted. In normal considerations where we earlier did cost sheet also, did we segregate fixed and variable under normal absorption costing, which we do? No, we don't. For us, what matters is whether it is manufacturing, whether it is office and administration, or whether it is selling and distribution. That matters. That classification was only there for us, not fixed variable classification. So both variable manufacturing overhead and fixed manufacturing overhead will be considered as production cost. So the cost of production is the total of all these things. Simply speaking, material, labor and manufacturing overheads are cost. Production overheads are factory overheads or works overheads. Then we get cost of production, and as we know, opening stock of finished goods is added, closing stock of finished goods is deducted. Then if there is any under or over absorption of the fixed manufacturing overheads, that should be adjusted here also, if there is any, because fixed overheads are absorbed according to predetermined rates, but actual overheads could be different, and that under or over absorption can be adjusted. Then after that we have to do the adjustment or addition for other costs like office, administration costs, selling and distribution costs. If we add, we get total cost. Deduct this total cost from sales, we get the profit. This is normal, nothing new as far as absorption costing is concerned. Same thing as we know in cost sheet, but only one way we can say, just instead of taking costs, then sales. We are taking sales first and then cost. Of course, costs are also taken and calculated in the same way. Finally, the total cost has to be reduced from sales. How we show it doesn't matter. Profit is calculated by reducing total cost from sales. That is absorption costing method. Now, what is the difference between this and marginal costing? If we calculate the profit using marginal costing method, only point is here. That is where you have to observe. What is the point there? There in the absorption costing, we included fixed manufacturing overheads also. That means that was also inventoryable cost. It was also part of the product cost. Whereas in case of marginal costing, we take only variable manufacturing costs as product costs. All fixed costs, including fixed manufacturing overheads, are taken as period costs in marginal costing. They are not product cost. In other words, the finished goods valuation that happens in marginal costing, if at all it happens, imaginary. In reality, nobody uses this. That's a different story. For us, questions will come, so we should be able to do both. Normal absorption costing, as we normally know. Marginal costing is only one difference here. It will not take fixed manufacturing overheads into consideration as part of the cost of goods produced. No, it will not. And that will not take naturally in the closing stock of finished goods also. So naturally what happens? Always the closing stock of finished goods in marginal costing will be per unit definitely valued lesser in the marginal costing when compared with absorption costing, because in absorption costing you include the fixed manufacturing overheads. In marginal costing you don't include fixed manufacturing overheads in the valuation of cost of goods produced or the closing stock of finished goods. Then we have cost of goods sold as usual. Then also have variable administration and selling and distribution overheads, so that we get total variable cost. And we know sales minus total variable cost is contribution, that is shown separately here. From the contribution, fixed costs are all shown. Here even production, admin, selling, distribution, all fixed costs are shown as period costs. These are all considered to be period costs, not product costs. And here what are considered as product costs? Only those product cost means which are inventoryable. Only direct material, direct labor, variable manufacturing overheads. That's it. That is how marginal costing calculations will be when compared with absorption costing. So to put it in a nutshell, profit under marginal costing will be different from profit under absorption costing because of changes in the valuation of stocks. Imagine if there are no stocks, then there will not be any difference. There will not be any difference. Profit will be same. Why? Because only value is changing, and change is coming where? Here. In this stock valuation. Last year also there would be variation that will be resulted in the opening stock. This year also there will be variation that will be shown in the current year's closing stock of finished goods. And what is the variation? In marginal costing, we take only variable manufacturing overhead into consideration in addition to direct material and direct labor. In absorption costing, we take anyway direct material, direct labor, variable manufacturing overhead, but we also take fixed manufacturing overhead, which means under normal absorption costing principles, which we normally follow, which we have been doing, we don't distinguish between variable and fixed manufacturing overheads at all. For us, manufacturing overheads matters. Fixed variable does not matter normally. But here in marginal costing, that matters. Only variable manufacturing overhead is considered to be a product cost. Fixed manufacturing overhead is considered to be a period cost. To that extent, there will be difference in the value of inventories. To that extent, there will be a difference in profit also. So simply the questions like this also can be asked here in the examinations. To calculate the profit as per marginal costing and as per absorption costing, and sometimes to even reconcile those profits. Such type of questions, 10 marks questions can be expected. This is a area usually lot of people leave, and definitely ICI will have an eye on this area, because it thinks if a question on this is asked, most of the students will not be able to do. It is not complicated, only that people are so reluctant to choose certain areas or leave some areas. Just like that, they think it is not a frequently asked question, so we can ignore it. Such type of thought process, if any of you have, you will be in problem. And if you face this problem for 10 marks and if you are not able to do that, that will be a shame, because it is a very simple and straightforward calculation. It will take time only for presentation, but calculations are all very simple. Simple cost sheet presentation in a reverse manner, and taking one common point of whether to include variable manufacturing overhead in the cost of production or not. Yes, it is absorption costing. No, it is marginal costing. That's all. Remaining is all presentation. You can use this format for presentation purposes. Same way it can be done in the examinations. Now let us look at this question which was given in the past examinations earlier. 5-Star Limited provides you the following information. Normal capacity is 2,40,000 units. Opening stock is 52,000 units. Units produced is 2,34,000 units. And units sold is 2,40,000 units. So definitely we can find out closing stock in number of units. 52,000 plus 234 minus 240. Closing stock units will be how much? 46,000 units. That is first thing. We can easily find out from the data that is available. Units, that is. Then direct material cost per unit is given, direct labor cost per unit is given, variable manufacturing overhead per unit is given, fixed manufacturing overheads is also given. Same way variable administration overhead cost per unit is given, fixed administration overhead is given, variable selling and distribution overhead per unit is given, fixed selling and distribution overheads is also given, selling price per unit is given 35. All that we need to do is prepare income statement using absorption costing and using marginal costing, and also prepare the statement reconciling the difference in profit, if any. And that is not over, since it is a 10 marks question. More other things are asked. Calculate break-even point and margin of safety, and how many units are to be sold to earn a profit of 25% on cost. Very perfect question that can be asked in the examinations, which was asked also earlier for 10 marks. So such type of questions can be very well expected. So let us start solving this question by taking first absorption costing principles, which is nothing but normal costing that we do. I'm not giving the descriptions and all, only just numbers I'm going to indicate here. But in the examination, naturally you have to also write descriptions. Now let us take sales first. Sales, particulars amount natural. Sales is how much? Actual number of units sold is 2,40,000 units, and selling price is 35 rupees. So 84 lakhs is the sales. Keep it aside. Then we need all the costs, and we are looking at absorption costing. Keep that in mind, absorption costing, that is. So in the absorption costing, we have to take all the costs including fixed manufacturing overheads. So let us take one by one what are all the items to be included in cost of production. So direct material cost, direct labor cost, variable overheads, which are manufacturing overheads, fixed manufacturing overheads also should be included in absorption costing method. So how many units are produced? Let us look at that. How many units are produced? 2,34,000 units are produced. So 2,34,000 into 6. What is the direct material cost then? 14 lakhs 4,000. And labor cost also will be 14 lakhs 4,000. Why? Because that is also 6 rupees per unit. Variable manufacturing overhead per unit is 3 rupees. So that means it will be half of that. That means 7 lakhs 2,000. Main thing is fixed manufacturing overheads. See, fixed manufacturing overheads is something that will be absorbed on the basis of normal capacity. Like 12 lakhs rupees is the fixed manufacturing overheads. Normal capacity is 2,40,000. What is the predetermined rate of fixed manufacturing overhead? Absorption, right? Overheads are always absorbed. Incurred is different, absorbed is different. There will be difference. So 5 rupees per unit is the absorption rate for fixed manufacturing overheads. So 12 lakhs divided by 2,40,000 rupees of 2,40,000 units, which is normal capacity. That is 5 rupees per unit is the absorption rate of fixed overheads, manufacturing overheads, and the units produced are 2,34,000 units. So 234,000 into 5. 11,70,000 is going to be fixed overheads, which are absorbed fixed overheads. 11,70,000 rupees. How is that? 234,000 units manufactured into 5 rupees is the absorption rate, predetermined rate. 11,70,000 is the fixed manufacturing overheads incurred. So these are all the various inventoryable costs, we can say. Administration costs and all will come later, and let us not get into this eternal dilemma of should we include administration cost also in the cost of production or not. If nothing is given, don't include them, just consider it as a non-inventoriable cost. If it is given that they are related to production, then include them, otherwise don't include them. So let us take only these things as cost of production. So 11,70,000 plus 7,02,000 plus 14,04,000 plus 14,04,000, total is 46,80,000 is the cost of units produced. Cost of production you can call it also, since there is no work in progress and all. Now, to this we have to add the value of opening stock and deduct the value of closing stock. How much will be the value of opening stock? Opening stock will be same. That is what? Here 6 rupees direct material cost, 6 rupees direct labor cost, 3 rupees variable manufacturing overhead per unit, plus 5 rupees, that is fixed overheads per unit. So 20 rupees is the inventoriable cost. 6 plus 6 plus 3 plus 5. So 20 rupees into how many units of opening stock is there? 52,000 units is there. So 20 into 52,000 means 10,40,000 is the value of opening stock, isn't it? That is 10,40,000. Now, what about the closing stock? Closing stock also is valued in the similar manner, wherein we have for total cost of 46,80,000 for how many units manufactured? 2,34,000, that means 20 rupees same, into 46,000, that means 9,20,000 is the value of closing stock. 9,20,000. So add opening stock, deduct closing stock. That's what we do normally to get cost of goods sold. So 46,80,000 plus 10,40,000 minus 9,20,000. So 48 lakhs is that. Of course, that is before administration costs being added. Then you have to do this adjustment for all the other costs, like variable administration cost and fixed administration cost, variable selling and distribution overhead cost per unit, and fixed selling and distribution overheads cost. All of these things have to be added. So administration cost per unit is how much? Variable 0.8 into 2,34,000 only, because that is the number of units produced actually. So variable administration overhead per unit 0.8 into 2,34,000, 187,200. Add that. Then fixed administration overheads 1,20,000. Directly we can take that. Then variable selling and distribution overheads 2 rupees per unit sold, that is. So 2 into 240,000, 4,80,000 is variable. Selling and distribution overheads. Then fixed selling and distribution overheads are 2,40,000. So all these costs to be added. Once again, taking admin overheads non-inventoryable. So 48 lakhs plus 187,200 plus 120 plus 480 plus 240, that comes to 58 lakhs 27,200. 58 lakhs 27,200. So that is the overall cost we can say. But one point to be noted also here is there is a difference in the manufacturing overheads. Fixed manufacturing overheads are actually 12 lakhs, but how much we absorbed? We absorbed only 11 lakh 70,000. That means 30,000 is under absorbed. 30,000 when they are under absorbed, that has to be added now as an adjustment at the end. So 58 lakhs 57,200 is what is total cost, we can say, after considering every cost. Then what is the profit? We know the sales already, 84 lakhs minus 58 lakh 57,200, that will be 25 lakh. Profit is under absorption costing 25 lakhs 42,800. That is the profit under absorption costing. That's it. That is one thing that was asked in the question. Now moving on to profit under marginal costing. So how this will change? We can do actually side by side also, but in the exam you do it separately. Sales is going to be same, of course. Material cost, labor cost, variable overheads are going to be same. Fixed overheads are not at all taken here. So 14 lakh 4,000 plus 14 lakh 4,000 plus 7 lakh 2,000. So variable manufacturing cost will be how much? 35 lakhs 10,000. So under absorption cost, under marginal costing, 35 lakhs 10,000 is the variable manufacturing cost or cost of production, only variable. But for that we need to add opening stock and closing stock. Opening stock and closing stock also valued at variable cost only. So variable cost only will be how much? Once again 6 plus 6 plus 3. That means only 15 rupees. So 15 into opening stock 52,000. That comes to 7,80,000. Then 15 into closing stock 46,000. That comes to 6,90,000. Only variable cost we are taking, 6,90,000. So 35 lakhs 10,000 plus 780 minus 690 will be 36 lakhs. This is the variable cost, we can say, manufacturing cost. Sales is there, which is 84 lakhs. But to this, only variable costs and all we have to add. Only variable manufacturing overhead to be added. So 3 into 234,000, 7 lakh 2,000. We already know that. Only variable parts only we have to pick. We have to exactly pick that. What is the variable manufacturing overhead per unit? Sorry, not manufacturing. We need administration overhead. Manufacturing is all done. Administration overhead 0.8 into 234,000, that is 187,200. This one we have to pick here, 187,200. And variable selling and distribution overheads 2 rupees per unit sold. So 2 into 234, 2 into 240 units sold, that is. So that comes to 4,80,000. So from the same thing you can pick these two, 187,200, 480. So 187,200, 4,80,000. So this gives us total variable cost, including all manufacturing, admin plus selling and distribution. So 42,67,200. In marginal costing statement, we need one more additional presentation, that is contribution, which is nothing but sales minus total variable cost. Sales how much? 84 lakhs minus this all total variable cost is contribution 41 lakhs 32,800. From this you have to deduct all types of fixed cost. Just take the actual numbers, that is enough. Absorption and all will not happen here. So 12 lakhs manufacturing, 120 fixed admin, 240 fixed selling and distribution. So 15 lakhs 60,000 is the total fixed cost. 15 lakhs 60,000 is the total fixed cost. So what is going to be the profit under marginal costing? 25 lakhs 72,800. What was the profit under absorption costing? 25 lakhs 42,800. What is the difference? 30,000 is the difference. 30,000 is the difference. Where from that 30,000 is coming? So that you can check from the stocks. Reconciliation can be done. So look at this reconciliation. Opening stock is 7 lakhs 80,000 in case of marginal costing, and in case of absorption costing it was 10 lakh 40,000. So 1040 minus 780, it was 2 lakh 60,000 opening stock difference. Closing stock 920 in absorption costing, 690 in marginal costing. So 2 lakhs 30,000. So 2 lakh 60,000 opening stock difference, which is more. Opening stock is more in absorption costing by 2 lakh 60,000, and closing stock is more in absorption costing by 2 lakhs 30,000. So naturally, when opening stock is more than the closing stock, or difference in opening stock is more than the difference in closing stock, absorption costing was showing naturally the profit which was lesser, 25 lakhs, opening stock is more. So 25 lakhs 42,800 only absorption costing was showing, and marginal cost is showing higher profit, 25 lakh 72,800. So marginal costing profit is more than absorption costing by 30,000. Why is that? Because closing stock is lesser by 30,000 than more opening stock difference. So when the opening stock is more, profit will be lesser. When closing stock is more, profit will be more. In this case, since the difference in opening stock is more than the difference in closing stock by 30,000, in absorption costing, naturally in both cases, whether it is opening stock or closing stock, absorption costing will always have higher stock valuation than marginal costing. Natural. Why? Because absorption costing includes fixed manufacturing overheads also. But the point is, which one is more than other? Is opening stock more than the closing stock, or closing stock more than the opening stock? In this case, opening stock is more than closing stock. So naturally what happens? Absorption costing will show lesser profit, marginal costing will show higher profit. What if the closing stock is more than opening stock? Then absorption costing will have more valuation of closing stock than the opening stock. So absorption costing will show more profit in that case. But here, since opening stock was 52,000 units, closing stock is only 46,000 units, that difference in the stocks of 30,000 is shown in the profit differences also between two methods of costing, that is 30,000. So absorption costing calculation, marginal costing calculation, statement reconciling the difference in profit, you can prepare by taking each of them and showing that. So let us say absorption costing profit we will start with 2542,800 plus 260 minus 230. That gives marginal costing profit. That will be naturally 25 lakhs 72,800. That is how this absorption costing, marginal costing statements of profit have to be prepared, and difference has to be definitely calculated, and always difference is only one. There is no multiple differences, only one. What is that? Stocks. Imagine if there are no stocks, no difference. Imagine if the stocks are same, opening stock, closing stock are same, still there no difference. Only difference comes when whether closing stock is more than opening stock or opening stock is more than closing stock, where the profits will be higher. If the closing stock is more than opening stock, absorption costing will have more profit. If opening stock is more than closing stock, marginal costing will show more profit. That's the application of concept of distinction between absorption costing and marginal costing. And other questions I think you can solve directly. Break-even point and margin of safety, how can you find out? Break-even point is what? Simply fixed cost divided by contribution per unit. That can be found out. Margin of safety can be found out, which is nothing but total sales minus break-even sales, that you can find out from the data. How many units to be sold to earn a profit of 25% on cost? That also you can do using the data that is available on the basis of actuals. So those two things you do it on your own, nothing special to once again explain, those are known things already. But difference between marginal costing and absorption costing is to be applied in this way. That is the question which was given in earlier exams. Now look at this question which was given in the ICA material also. Wonder Limited manufactures a single product Jest. The following figures relate to Jest for a 1 year period. If the activity level is 50% and if the activity level is 100%, what will be the sales and production in units? Units, that is given as 400 units and 800 units, that is. But sales are given in rupees also, 8 lakhs and 16 lakhs. Naturally they will be doubled because the capacity also doubled. Variable cost will double naturally because they will change in the same line. Fixed cost will not change because it will be same irrespective of the level of activity, very clear. Selling and distribution cost also variable and fixed. Variable doubled because it is production doubled or capacity doubled. At a different level of activity we can say. Fixed cost remains the same. So data is very simple and straightforward given at two different levels of activity. The normal level of activity for the year is 800 units. That is the normal level of activity, 800 units. Fixed costs are incurred evenly throughout the year. That is always a normal assumption that we take. Without that, many calculations will go wrong because we have to take fixed costs proportionately on the basis of time. There is no option. And actual fixed costs are the same as budgeted. So actual fixed cost and budgeted fixed costs are same. There were no stocks of Jest at the beginning of the year, means no opening stock. There is no opening stock. Only closing stock is there, if it is there. Now in the first quarter, once again, read the question carefully. This entire 800 units is for what? Activity level for the year. But here what is telling? Only first quarter. 220 units are produced, 160 are sold. That means how much is closing stock? 60 units is closing stock. That is evident from the data that is given. Now what is required is, what would be the fixed production cost absorbed by Jest if absorption costing is used? Fixed production cost, how much will be absorbed is asking. It's a straightforward thing. Production fixed cost 1,60,000 is the total. Normal capacity is how much? 800 units. Per unit, what is the absorption rate, you can say, overhead rate per unit is 200, isn't it? 160 by 800 is 200. But how many units are actually manufactured? 220 in the quarter. That means absorbed fixed overheads are how much? Naturally 220 into 200, that comes to 44,000 rupees. That's the answer for first question. Second question, what would be the under or over recovery of overheads during the period? How do we know that? Because this is absorbed. What is actual? He said as budgeted only it is actual. What was budgeted? 1,60,000 for the entire year. If 1,60,000 for entire year, for one quarter how much will that be? Divided by 4. That means 40,000. Which means, is there over absorption or under absorption? Absorbed is more than actual. That means 4,000 rupees over absorption of fixed overheads is there according to this data. That was the question B. Then question C, what is the profit using absorption costing and what is the profit using marginal costing? That is also asked. So for that you have to prepare the statements naturally to show what is the profit under each of these methods, both absorption costing as well as marginal costing. So let us take absorption costing first. Sales, actual sales during the quarter are how many? 160 units are sold at what price? If 16 lakhs sales happen for 800, selling price will be how much? 2000 naturally, no? Isn't it? 2000. So 2000 into per unit 2000 into how many units are sold actually? 160 units are sold. That means sales is 3,20,000. So each of the calculations we have to do. Sales 3,20,000. Now we are using absorption costing. So let us take the costs one by one. What are all the things to be taken here? All things, including variable and fixed production costs we have to take. So per unit, how much will be the variable production costs? That can be found out by taking any level of activity. So 320 by 400, 800 or 640 by 800. 800, whatever it is. So variable production cost per unit is 800. So 800 into what? How many units are produced? 220 units are produced. That means 1,76,000 is the variable production cost, not just overheads, all of them, all costs, variable production costs. 1,76,000. Fixed production costs, that we already calculated. How? That is there absorbed. 220 into 200, 44,000. That is there, 44,000. So what is the total production cost? 176 plus 44,000 means 2,20,000 for how many units? 220 units. But how many units are there in stock, closing stock? There are 60 units. So if 220,000 is for 220 units, how much will be for 60 units? Naturally 60,000. No opening stock. So only deduct closing stock. So 220 minus 60 will be 1,60,000. Cost of goods sold, we can say. Then add variable selling and distribution cost and fixed selling and distribution cost. Fixed anyway is there 2,40,000. That is not going to change. Variable selling and distribution cost will be per unit how much? That again you have to calculate. 320,000 divided by 800. Per unit it is 400. How many units are sold? Only 160 units are sold. So 64,000 is the variable selling and distribution costs. Add this cost also to this. So 160 plus 240 plus 64. 4,64,000 rupees is the total cost. And how much are sales? What is it? Why this much difference? Sales are 3,20,000 only. Sorry. Here we are gone wrong. This is for year, no? 2,40,000 is wrong, no? Naturally, it will be shown. 2,40,000 is for year. We cannot take that. 240 for year means each quarter how much will that be? 60,000. Be careful. Not 2,40,000. 60,000 only. We are only looking at one quarter. So how much is the cost now? 160 plus 60 plus 64. That is the total cost. 2,84,000. That is the total cost. Then sales 3,20,000 means profit under absorption costing is how much? 36,000. That is the first method under which we calculate profit. Of course, you have to show these things in a better presented manner in the examinations, writing the details. Now, what is the profit under marginal costing? Let us see that also. Sales will be same. That is 3,20,000 obviously. Sales 3,20,000 is not going to change. But main point is here about the variable production costs only, that will be taken 1,76,000. And 1,76,000 is there variable. Fixed do we take here? No, we don't, because it is marginal cost. But you have to deduct closing stock definitely. If 1,76,000 is the variable production cost for how many units? 220 units. Naturally 800 per unit. How much will be for 60 units? That means 48,000 is the closing stock under marginal cost. Only taking variable costs, variable production costs. So 176 minus 48 means 1,28,000 rupees is the, we can call it production contribution, though we don't have to give any name for it, but let us call it production contribution. From that deduct other variable costs like selling and distribution cost. Variable selling and distribution costs are how much? We already calculated earlier. Variable selling and distribution costs are 64,000. That will be same, 64,000. So what is going to be the contribution now? 128 minus 64,000. 64,000 is going to be the total contribution. Then from that you have to deduct the fixed cost. So what are the fixed costs here? Fixed costs are two. One is fixed manufacturing costs and the second one is fixed selling and distribution costs. Both of them put together 160 plus 320. For entire year they are 480. For each quarter it will be 1,20,000. So 1,20,000. I think somewhere calculations went wrong. 176 minus 48 is 128. That is okay. Where we? Okay. Unnecessarily we are doing this cost. This one created everything. So this is cost separately. Keep the sales separately. Keep the sales separately. 176,000 is the variable cost. Deduct closing stock and add to get variable cost. 128 plus this is wrong. This is not contribution at all. This is 128 is cost. How can it be contribution? So 128 plus 64,000 is variable. Total variable cost we can say. If at all you want contribution, that can be shown separately like this. 192 separate minus 320. That is 1,28,000 is the contribution. Correct. So 1,28,000 contribution, if at all it is 320 minus 192, 1,28,000. So how 192? 176 minus 48 plus 64,000. Correct. So 128 is contribution minus fixed cost. How much? Both production and this selling and distribution put together per each quarter. That came out to be how much? Fixed 160 plus 244. 160 plus 240. 4 lakhs divided by 4. That means 1 lakh fixed cost. Correct. 1 lakh is the fixed cost per quarter. 1,20,000 is also wrong. 1 lakh is the fixed cost per quarter. So 28,000 is the profit as per marginal cost. That's it. So profit as per absorption costing is 36,000. Profit as per marginal costing is 28,000. That is the correct one. Be careful with this. Sales you have to keep separately. Don't mix that with the costs. Costs, all the costs once you calculate, then only you calculate the contribution and other things. So here, variable production cost minus closing stock plus variable selling and distribution cost will give us total variable cost. If you deduct this from sales, you get contribution 128. Deduct fixed cost, you get profit of 28,000. Profit under absorption costing was 36,000. Isn't it? 28 and 36. I think one thing. Now here, one more adjustment to be done, right? Because after the calculation of all this cost, so there is a over absorption of fixed overheads here at 44,000, which we already calculated, 4,000 over absorption. So that should be reduced from the cost actually. So 284,000 will not be the cost. If you reduce that 4,000 also from here, naturally it will be 280. This adjustment should not be forgotten also. Then naturally profit will be 40,000 under absorption costing, not 36,000. Because there was over absorption of fixed cost, that adjustment has to be done before calculating profit at least, at the last step. So profit is 40,000 under absorption costing and 28,000 under marginal costing. We can see that. How do we know that there was a mistake? Easy. When you look at the stock figures, in absorption costing it is always higher. It was 60. In marginal costing it was 48. And what is the difference? 12,000. That 12,000 only should show. So profit under absorption costing is more by 12,000 than profit under marginal costing, exactly because of the difference of 12,000 valuation in the closing stock, which will be always more in absorption costing. Since there are no opening stocks here, Only absorption costing is having more closing stocks value than the marginal costing stock valuation by 12,000. That difference of 12,000 is shown in profits also. So these are the points to be noted while calculating profits under two different methods, marginal costing as well as absorption costing. Practice them on paper as many number of times as possible. There is one more question also for practice in the essay material which you can do related to this computation of profit under absorption costing and marginal costing. So that type of question can be also very well expected, and as I said, it is generally the surprise element that ICAI keeps it with itself, and if that is shown and shooted against us, you cannot say that I just ignored this aspect and all. No, it is simple, but you have to be careful naturally in the calculations, looking and using the concept of taking total production costs including fixed manufacturing overheads also under absorption costing, whereas taking only variable manufacturing overheads under marginal costing. Using these formats you can present them well, but presentation will come only with good practice. You can solve this question quickly, accurately, and present it well only when you put pen on paper. So while you do practice of these questions, use full forms of description and try to prepare and present as if you are presenting in the main examination. So these type of questions also can be expected from this particular chapter.